Hey everybody, Preston Brent here with our weekly roundup brought to you by our Trader User Group. This is for the week ending October 26, 2018. Boy, you guys, I know all of you guys, or a lot of you guys probably celebrate Halloween, and that's generally where some young little cute kid shows up at your door and yells trick or treat, and you always got a box of candy ready for them, and you just put the candy in their bag and away they go, and everybody's happy. The kids get their treats and sweets, and you get a nice satisfaction knowing that you gave some kid a possible toothache about a year from now. But now the market price action is completely the opposite. Instead of a young little kid dressed up as Mickey Mouse at the front door, it's the market price action. And when they showed up at your door and the markets knocked on the door and you gave them treats, meaning good corporate earnings, this time there are no treats, it's only tricks. So it seems like with corporate earnings coming in relatively strong, we're still seeing stocks suffer. In fact, I bet if you had an idea of exactly what the corporate results were going to be beforehand, you still probably wouldn't get it right. This has been one of the worst months of October in over almost a decade. So clearly, it's a Halloween trick or treat, mostly tricks rather than treats, as I said. We've seen all the markets go down. We've seen volatility this week move up, I guess about just slightly under 22% to close the week out at 24.16. The best performing sectors are risk-off sector, the consumer staples, the worst, industrials. Technology, the selling still continues. A lot of people are trying to pin fault at this market exuberance that we've had over the past 9 years. A lot of people feel that we've got we're at a past the peak earnings cycle. People blame the trade tariffs. A lot of people are trying to pin the blame on the Feds. When Jerome Powell came out on October 3rd and he said that they have a way to go before reaching a neutral Fed funds target rate in their currently, quote unquote, extremely accommodative current range of 2 to 2.25%. So the markets interpreted that as a more hawkish Fed tone. And that really, if you go back and look at the charts, is when the market started selling off pretty hard. Yet the Feds are still committed to 4 more rate hikes. The markets are only putting in about a 1 more rate hike in 2019 and about a 69% chance of a rate hike this December. So 2 more versus the Fed's 4 more. The Feds generally are always overly optimistic in their growth forecast. Now, keep in mind, the current PE ratio is sitting right around, and that's forward guidance, not trailing. So forward 12-month PE ratio is around 16.09 or so. And October of last year is at 22. So the PE ratio is off by 26.86%, roughly. So the valuations are coming down. And that's typically the case when you have the anticipation of higher rates in a strong environment or the possibility of higher rates as per Jerome Power Ranger Powell on the US Fed. So that is just seen this past week. We saw the markets, about $1.2 trillion came out of the equity markets this week. And we've seen about 3.3 trillion equity value evaporate in the month of October alone. So even though we've got corporate earnings on track for about a 22.5% rise year over year, there are many of them that are missing their forward guidance, are pulling back just a little bit. Markets are interpreting this as peak earnings, so they're selling off that coupled with the higher interest rates and then the possibility of the trade tariffs, because already it didn't show up in Q2 earnings, but in Q3, we're starting to see companies like Caterpillar and Honeywell and Lennox come out and say that trade tariffs are starting to impact their bottom line numbers. Now, so far, all of those companies have said they've not raised the prices of their products because of the tariffs. They're holding it out in hopes probably for another couple of quarters in that Trump and Xi will come to some kind of agreement. So I guess that makes this upcoming meeting in November between Xi and Trump a very important one. So we'll see. As I've been telling all our members, the markets are going through a repricing. I don't see a bear market. I don't see a recession near term. But I do see a repricing. Again, what drives in, price levels over a longer term period time? It's very simple, guys. It's earnings per share and it's interest rates. The higher their interest rates go, the harder it is. It's going to drive PE ratios down because money now has another place to park itself instead of just the equity market in search of yield. Okay. If you were to take the earnings of the S&P 500 and divide it by the index itself, you're going to come out with a number that's a little over 5.5%, almost 6%, which is about 3%, maybe roughly around the 3% level, over and above and beyond the yield that you're getting in the S&P right now. And markets generally, big money demands a yield premium, or what we call a risk premium, to own equities versus put it in a risk-free 10-year treasury note. So this is kind of what's going on right now. Markets and equity values are being readjusted in value. What you see on the screen here is a weekly chart. So it's a little bit busy, but let me just kind of point out a couple of key things for you here so that you can see, what I'm doing. You can see here in January of this year, we had a 12% pullback. All right. And that really would be defined officially as a correction. As all of our members know, I define a dip as less than 5%. I define a pullback as greater than 5% up to 10%. And then the markets take over, and then the official market correction is 10%, official bear market is 20%. So we had a correction in January. That was the pullback. All right. Now, you can see that over on the far right-hand side of the screen, if we were to come back and test the lows that we made in early February, that would give us a 14.18% correction, which I think we may end up getting to, okay, not without a 1 or a 2 week bounce. Okay, now remember, this is a 3 week bounce. Notice this is a weekly chart, but we had a really good bounce right here to the tune of about 300 E-mini points. And then it rolled right back over and came damn near close to retesting those lows and recalibrated before the markets felt comfortable going higher again. And then we ran up the rest of the year, leading into this October Halloween trick or treat time. Okay. So we need to have a bounce. And then we probably, in all likelihood, will get a market rollover to retest the lows again. So I think, and again, this is just speculation because you never really know. You got to follow the price action, but I suspect we're near a bounce level. But if we get a bounce, as I'm telling our members, we are in a sell the rally mode at this point in time. If we do get a bounce, and that bounce is probably going to take us up around the 200 EMA. I'll show you on a daily chart in a minute. We may even move up above it into this little shaded zone right here and then come right back over and then probably come down and make new lows, flush the market out. And then we're going to say, now where do we want to go from here? So we've got this level in February, all right, of 12.07%. Pulling back to the February lows now gives us a 14.18% pullback simply because we were at a higher high here. Now, notice right now we were in correction territory, but when we closed on Friday, we're down 9.66%. All right, that's where we are right now. Now, this upslope and trend line starts back in March of 2009, the secular bull market. And if you will notice, we can come down here and touch this and be slightly less than an official bear market, maintaining our secular bull trend. That would take the E-minis down to roughly, let's call it the 2300 level, 2350, 2375 area, and still be in a bull market. But, so these are levels that we need to watch very closely. Okay, the 2529 level as shown here, which is the same level that's right there, right? The February lows. And then this one right here, which will keep us just slightly above a official bear market, yet keep us in this secular growth trend right here. Remember, we're over 9 years in this secular bull market. And you can see all of these lows here, and you can see I've highlighted the Trump election lows right here. I was having our members up 2 o'clock in the morning, right in this area here when Trump's been elected. I mean, we're just been off to the races. So since his election, the markets have shown huge progression. All right. And granted, he's Red Bull the market with tax cuts less regulation, repatriation of money from corporate, excuse me, corporate coffers and so forth. So this is kind of where we're sitting right now. All right, these are the key levels I want you guys to pay attention to. And then my thesis and the way our members are working right now, we were in a buy to dip, but we've shifted to a sell the rally mode until we can get and maintain our 200 EMA. All right, that's key. And it's just a real simple gauge, but it works all the time, guys. I started our group in 2008. When I started our user group, we were in the throes of the beginnings of a huge bear market. And we made great money at that point in time. As we're doing this really strong capitulation here, and I don't think we've really capitulated yet, but let me put it back on a daily chart. You can see here on this daily chart, I've got a fan wave here of trend lines, and we've broken all three. And you can see where we are right now. We're slightly below the 2018 open price. This was the closing low on Friday, which was off the lows for Friday, where we were in correction territory, but now it's just down 9.66%. But, you know, call it pretty much a correction. All right. And I believe we're going to get a bounce. I can't tell you when that bounce is going to happen, but what I can tell you is when we do get a bounce, be ready to sell that bounce. All right. If we roll up and we get a roll up in the MACD here, all right, and my settings on the MACD are at 618.6. They're not out of the box settings. These are the settings you want. They're a little bit tighter and they're a little bit more sensitive to daily movement. We can get them run up here. Now notice the 200 EMA is sitting at 27.55. All right, we closed at 26.62. So about 90 points, 85, 90 points roughly away. That's not a big move at all. Remember, I said in February of this year, the E-minis moved up almost 300 points and gave it all back up again. And and that's based on a lower price point than where we started this one from. All right. So if we moved up, I could see us moving up to this level up here, the 2,800, possibly up to the 50 EMA, and then rolling back over again. But I still don't think the overall down move is over with yet. All right. So just kind of bear that in mind. But again, I also don't think we're going to go into a bear market. If we take out the 2018 lows, then the next step is this low down here, as I showed you, this long secular bull market trend level. All right. And that carries us down. But notice what I believe is going to happen on Monday and Tuesday. Keep in mind the Friday lows. All right. Keep in mind the Friday lows. They're going to be very important. And because what we can do is do one of these kind of moves up here, and it'll be fast and furious because there are a lot of shorts in the market. And then we pull back, scare the children, come up here, and then we kind of ponder, and then away we go. And then it drops really quick again. We test this and then start a long, slower build. That was the scenario that happened in February this year. Is very similar to a scenario that we had in 2016 as well. Very rare do you get a downdraft like this in the markets, right? And then it comes and it goes like that. But then you have one of these kind of things, a V bottom. You generally have a couple of tests around the bottom here. So this is our first pass right here. That would be like this right here, a first pass. So this kind of move would be like that. And this is rare. You generally have pass number one, a little bit higher, pass number two, and then you can start the build. So you generally get one of these kind of things like this. All right, so that would put us down around these levels down here, south of the 2,600 level into the 2,500 level. So that's what I'm looking for, but not without a bounce. Okay, not without a bounce. Keep in mind next week, the other FANG stock we get is we get Apple on Thursday. Some of the key earnings next week. We also get Facebook on Tuesday, where they've been crushed. We get a little bit more view into the consumer with MasterCard on Tuesday as well. So we get a couple of those things on the earnings docket. We've got Bank of Japan interest rate announced on Wednesday. You know they're not going to hike the rates. I mean, that's crazy. And then we get the Friday Employment numbers, it's forecast to hold at a 49-year low of 3.7%. So this is a little bit about where the markets are sitting, guys. It's not that pretty, but if for those members that are in our group that are just kind of following what we're doing, we've been making some money here. We've got some steady trades on here that are designed to make money in this kind of downdraft here. Okay. If we come over, and let me just go out to the monthly and I'll show you that secular bull trend here. All right. So there is the long bull trend here, starting back in March of 2009 when we hit our lows, all right, of 66575 in March. And then you can see we've touched it once, and then we touched it the second time we touched it in the first time we touched it was in 2011. We almost went into a bear market, but we didn't. It held up. Next time we touched it was in 2016. And you can see these big moves here in 2016. Now, this is a monthly chart, but you can see the big move down here, and then the subsequent bounce, and then we came right back down and retested, then we're off to the races again. So we touched it there. And then we just got a little bit over exuberant, I think, since 2016, all the way up here. And you can see that big monthly candle there, taking out 1, 2, 3, 4, taking out 4 months of gains, all the way back to June of this year. Almost all summer gains have been wiped out in the month of October. Okay, that's how. And if you look at the candlesticks here and just kind of look at them and compare the size of them, you can see the the damage that was done. Okay, but you can see we can still come down here and find support at this level and still not be in a bear market, but it will feel very painful. All right, I don't know if we're going to fall that far. I do believe the odds do favor a testing of the 2018 lows of 14.18% pullback of where it would be now versus the 12% pullback that we had in February. Okay, so I just wanted to kind of give you a landscape view of where things are right now. Okay, and that's a little bit about what we look at. Now, if we look at NASDAQ, these guys have come undone. I mean, just truly undone. If we take it out to a weekly chart, just to show you, you can see here that on this weekly chart, here was a trend level that started back in 2016. Okay, I could have started it actually in February of 2016. And we're just now taking that out right now. It's held up very nicely. Since 2016, technology has kind of led the way in the markets. Money has been there. So what happened? Just like in February when we had an over allocation of shorts in the volatility market, and then volatility just went blasting higher back during this time frame, all the hedge funds had to rush for the stage door left exit at the same time, buying back their shorts in vol, and then that caused vol to really spike, which then became the unwinding of XIV, and XIV actually liquidated. Okay, now going forward, hedge funds are at it again, selling volatility, but not to the level that we've seen in 2016, 2017. So that gives me a little bit of comfort. And the fact that volatility didn't just explode higher on this thing is also a good sign as well. Okay, so that's kind of where we're sitting here on this. I accidentally moved my line here. I wish these things would lock in, but we're probably going to come down and test the lows that were made and the opening price in NASDAQ. You can see it's a little bit ugly. We've taken out the trend line. So that suggests to me that we don't have much further to go before we get a little bit of a bounce higher. All right, but we're getting a lot of unwind in the tech trade. And then, of course, if we look at the Dow, which was the strongest chart, believe it or not, going into this big unwind, has totally now moved into the red for the year, just like the S&P. It's in the red. You can see this great unwind. We've taken out the 50 EMA. We're below, so we've got a cautionary flag on now. We're still in a sell any rally in the Dow kind of concept. You can see this longer term trend line for the Dow will take us down even more. Okay, so all of these look really bad. Now, what's even worse, let's look at the Vanguard All World Index. I hadn't even had a chance to mark this yet, but the All World Index is down at this level here. We're more than official correction territory. If I were to put this on and then just plot the new one right here, let me just do this real quick for you guys. You can see here, we're now in official bear market territory for the all world index. And you remember the thesis that I've been saying for the past 2 months, would the rest of the globe pull back the US? And I've been saying you can probably anticipate that's going to happen, but the degree to the pullback is harder to tell. Okay. But we're in an official bear market for the Vanguard All World Index. And then if we look at emerging markets, all right, EEM, and take this one on. I haven't marked this one either, but I will do the same. You can see where the emerging markets were close, almost, but let me just see here. Let me take this one and edit it and put us down to 38.13. We're in a bear market, all right? I mean, we're clearly in a bear market on this thing, 26.79%. Now, the only one that we've been trading, we've had in our portfolio for the past 4 weeks, we've done great by it, and we got out of it a week ago for nice profits, was Brazil. I'm watching the elections this weekend, and should our guy win in Brazil, it's going to be another home run trade for us. So while the rest of the emerging markets was tanking, Brazil was going up strong. Okay, so we're going to take a look at that one again. The other one that's been moving up strong is Turkey, but I think that one's kind of had its run. So this is kind of what we're looking at for this. Now, of course, if we look at the VIX, you're going to see here, as I've showed you, here is the VIX. Now, if we go back and compare it to January, right? Notice these big hair on the candles here. This was the liquidation of all the hedge fund shorts. It caused it to move all the way up to almost 50 and then actually close on the day around 37. Those were just spikes. And then we had another spike, and it took 1, 2, 3, 4, 5, 6, 7, 8 days, over a week, to get back below the 20 level in volatility. So if we come over here and start counting these, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. We're 12 days in, which we're starting to set a record. We're in the top 5 for how long the VIX has stayed up over this level. So that would tell me that we're going to get a bounce. Now, we may get another spike, but this is an area where for you options folks out there, and we're options players, you want to take a look at some deep out of the money puts, some credit spreads, high implied relative volatility ranks and things like that, and take advantage of some of these things, okay? We're doing that in our membership group as well. Now, it's painful to hold, I must admit, but the odds favor this coming down. We're going to stay relatively high for a while, because if you come back and you look at January, once we come back below 20, I mean, we literally, once we got below 20, we had a couple of bouts a little bit higher, but we essentially stayed above 20 from the middle of February to the middle of May. 4 months. All right. Once you have these big bouts of volatility, this one may not last 4 months, but it could last at least 60 days. And if you look at the vol skew, the term structure of volatility futures, I haven't seen it like this. It looks kind of like the oil futures term structure looked about 3 months ago. It's all in backwardation. You've got to go out to February, March of next year to get the yield, the term structure to actually flatten out. That tells us the market is fearful going into Q4, November and December. We've got midterm elections coming up. I think they're going to be a nothing, to quote Hillary Clinton, a nothing burger for the markets. In fact, if the Democrats win, that means it's going to be a do nothing political party, because the Republicans, if they hold the Senate, they'll counterbalance whatever the Dems want to do, and then they're not going to let Trump do anything. All right. If the Republicans win, you can expect a little bit more of an increase in some Red Bull into the market, I guess, with possible tax cuts and a few other things. If the Dems win, one of the things that may be some winners is infrastructure spending, because both Repubs and Dems want that. So some of the infrastructure stocks may work out really well. For our members, we'll go through some of that in more detail in the coming weeks. So this is kind of how the markets are shaping up, guys. Again, I'm not calling for a recession. I'm calling more for downside. We can expect a bounce, but I don't think the selling is over yet. If we look at treasuries in the bond market, you can see money is kind of now starting to come back into the bonds, but not very much. I would be more interested in selling the bonds up in this level up here than buying bonds. Okay. Now, if we go into a bear market, all bets are off. I don't think that's going to happen. We could have some spikes higher and fear, but I just don't see that happening. Same thing if you don't play the bond market, you would look at, picking up some puts or some put spreads in TLT. All right. We could have some spikes higher, but I think the longer term move in TLT and bonds is down. Interest rate wise, I think we may have made our highs for the interest rates for the year. All right, you can see how interest rates have backed off of these. I've been calling for interest rates to come down, which would then mean the counter bonds to move up just a little bit as we go through the end of the year. And then, of course, if we look at currencies here, you'll see the US dollar is getting stronger only because the euro is getting weaker. All right. We had this breakout right here. I think the dollar is going to come back and retest this level. Should it retest and hold and then move up, we're going to make new 2018 highs. It's all going to depend on where the euro goes. All right. And the euro is going to go where if they can settle the Italian debt budget issue with the ECB and work out a solution, then the euro is going to bounce higher. We're near our 2018 low for the euro. Okay. This was my level for going back to the summer months around 114.6. You can see it. It's kind of holding. I mean, we blew through it, but that's kind of the area that I've seen as a fair value for the euro. All right. A little bit right in this area here. So, and we're moving right back up into that fair value for the euro. If we look at gold, gold has moved up a little bit, but this is a reason why I don't think inflation is an issue. Gold has moved up. We had a breakout here, but as you've heard me say again and again, I don't think gold's going to recapture its 200 EMA. I would change my stance on gold if it did, and then it held on higher volume, but I don't see that. You can see I've got a 5 over a 20 EMA on volume. And you can see the 5 EMA has crossed the 20 EMA to the downside. There's low volume here. Now, as we moved up, volume moved up. All right. So all that just means is gold is consolidating in this area here. If we break out here and take over the 200 EMA and hold it, then I will switch my theme on gold. But for now, I'm not playing it, and I don't think it's got too many legs near term because I just don't see inflation on the horizon. Okay. Now, if the Feds come out and cut rates, the dollar falls a little bit. That'll goose gold just a little bit, but it's not the fear gauge that it has been in the past. And that's evident by the price action on gold. Same thing for silver. Oil and energy. Well, you guys know my thesis on that. I've been saying oil is pulling back. Everybody's been saying oil is going higher. I'm the one of the few that has said oil has been pulling back. I had called for the mid to low 60s. We came right down and hit the 65.76 area. I was thinking it was going to come into this shaded zone here, and it may still. You can see the 200 EMA technically provided solid support. We're getting a little bit of a bounce. I'd be more willing to sell this bounce than anything else. If I get a signal on a shorter term basis, that would be a higher prob trade to take. And then oil coming down here. Keep in mind, November 4th is when the markets are going to really be able to calibrate just how much oil came off the the global markets with the Iran embargo. If a lot of oil came out, then we've got an abundance of inventory right now to make it up. And the Saudis are in debt to Trump because Trump's going to make them pump more oil because the Saudis want relief from Trump from this idiocracy that they pulled over in the Turkey consulate area, which was just a boneheaded move. But I think net oil is probably going to be more lower than higher. Now, also, if you'll look, one of our favorite trades in oil has been the spread between Brent and WTI. Okay. Anytime, I think the spread is going to stay bid and go wider until we get through November the 4th. If more oil is coming off the market, you'll see this spread widen. Why? Because Brent is going to be more affected by an Iran oil embargo than WTI. All right. If less oil is going to come off the market and that abundance of crude sits there, you're going to see this spread tighten. And this would be a good short opportunity. Okay, so the way you would short the spread is you would sell Brent and you would buy WTI oil futures. Okay, now you could also do that by doing BNO, Bravo November Oscar, which is the ETF for Brent, or USO, Uniform Sierra Oscar for US oil on the ETF. And then you can buy one and short the other. Just make sure you keep your notional values equal if you didn't want to do this. It's $1,000 a point if you go long or short the spread. Okay. Now we've got some other things that are starting to percolate in the ag market. And then we've got a number of things that are floating around in some of these sectors, as well as I kind of mentioned briefly one of them in the countries that we're tracking. Other than that, everybody, that's kind of where the markets are sitting. So net, I'm going to be expecting shortly a bounce. Then that bounce may take us up to or north of the 200 EMA. More than likely, it'll pause at the 200 EMA and roll back over. But we may go higher. But even if we go higher, I'm going to be looking to set up a sell. I'll be looking for sell signals rather than long signals on this bounce higher. All right. And then I would like to see another rollover. This rollover right here from this bounce didn't really count. It was only 1, 2, 3 days. That's not long enough. And then the fourth day, we had a candle that suggested it's going to roll over. This candle here was just a really good signal. If you look at this candle, it almost looks like a gravestone doji right there. And that was the signal to say, okay, we're going to roll. All right. So away we went. But that's not a long enough a period of a bounce to this to count. And even the MACD doesn't even show that it's an adequate bounce. What we need to do in these bounces, and again, it's very rare that we get a V bottom, is get the prices up like this. However we get up there, have the MACD cross, move up like this, right? And then when we get another rollover, it's not going to be met by the same number of sellers. We'll get a MACD at some level like this. And then that will give us the bullish divergence that we're looking for and an all clear signal. If we don't get this and the prices do in fact bounce, but do not go as high, and then come back over and take out these, then that means we're still in an Elliott wave 3 count and we're going to go lower. This move here was not enough to take us out of an Elliott wave 3 count. That was why we got the look and feel of the MACD at that level. Okay, so everybody, make sure that you've got some cash on the sidelines to take advantage should we go lower, because valuations are getting less. And as I always tell our members, we want to be there with cash on the sidelines to take advantage of some of these moves once we get lower. Now, if we start to shift, as I showed you earlier, and we take out some of these lower lows here, then you just stand aside and wait until we get some all clear indications to make a play to the upside. Members, I will see you Sunday night. Everybody else, have a great weekend. And the market send its Halloween trick-or-treat love. Ciao, folks.